watching Morning Markets with me, Amber Canwar, on BNN Bloomberg. It's a new show here, but I've been slowly bringing back some of BNN's fan favorites, including our next guest, David Taylor, who was, I guess, formerly of Taylor Asset Management. What are you up to these days?
I'm quite busy, but I manage my own money, not managing money for clients. I sit on a couple of boards, including PI Financial, which is fascinating. I did a little shareholder activism on a gold company.
When you were retired?
Yes, when I was retired.
So you don't know the meaning of the word retired?
I don't, and I'm a musician. I play keyboards in a band.
What's the band called?
It's called Uproar. We have a gig February 17th in Oakville.
Oh my gosh, can I find you on YouTube?
Yeah, yes.
Okay, Uproar. Well, I'm going to do that in the commercial break. But ahead of that, I do want to get your view on kind of the overall market. And you have seen a lot of cycles, right?
Yes.
Whether it's commodity cycles, market cycles, and right now we're in a cycle when it comes to the tech sector. How are you thinking about the layoffs, kind of the rollover of the tech sector in the current rate environment? What do you make of it?
It's fascinating to watch. I mean, I have seen many cycles, but it's amazing that these growth stocks that people flock to, that desperately needed in low interest rate environment, are now the ones that are leading the layoffs. And so when interest rates rise, clearly, people don't need growth as much now. They need to compete against GICs and fixed income.
Yeah.
And a lot of those companies didn't offer dividends or income. And so I've seen this massive switch, obviously, to value. Like people threw away oil companies, they threw away steel companies, and there's some of the and base metal companies. And these have massively outperformed tech companies. So it's fascinating to watch where people are talking about recession. Everybody talks about recession, yet copper prices are up 50%, oil's at $80, iron ore prices are up 50% off the bottom. So it's this massive dichotomy that we see. And unfortunately, I think tech overinvested, and I think investors were overinvested in tech. So it's just a massive unwind, I think, of growth at any cost into I think, value. And I think that's what these tech layoffs are telling us. That kind of got the message from investors that growth at any cost certainly is over. That was a story that hit Netflix particularly hard, especially as it started to lose subscribers. But recently, it's found some momentum. We can take a look at Netflix shares. It's added millions more subscribers in its most recent quarter than expected. The stock is rallying up nearly 8%. Our next guest says he is not recommending investors buy the stock despite the stunning rally that we have seen. Let's bring in Dave Heger, senior analyst, equity analyst at Edward Jones. Dave, maybe let's just go through the quarter first, because there were a lot of surprises. And the main one, two of them, Reed Hastings no longer CEO, but also, they added way more subscribers than expected. Did you get color on what was driving that?
Yes, well, certainly the company did add quite a few more subscribers than were expected and more than what the company had originally guided to. And it looks like a couple of factors were behind that. First of all, it was a strong quarter for content and new releases of programming. Shows such as Wednesday and the Glass Onion movie were very popular. But also in November, the company rolled out its new ad-supported tier of service, which it looks like that might have also been a driver behind the strong subscriber growth. And I think the combination of adding that tier plus the strong content helped with both retaining subscribers and with adding new subscribers.
And so I want to get to why you have a hold rating, but as I looked at the quarter, it wasn't perfectly clean. There were certainly areas of weakness, especially on the bottom line. And it looked like, correct me if I'm wrong, but their forecast for profit was also light. I mean, depending on the mood of the market, that could have been enough to take the stock lower instead of higher today.
Certainly the numbers were not perfect from a financial point of view. I will note, though, the bottom line earnings number reflected an adjustment for foreign exchange related to debt that the company has in the European market. And if you had adjusted for that, the earnings would have been fine. Certainly, though, the company, I think, is increasingly going to be trying to focus investors on the financial results, being in terms of revenue and earnings per share, as it moves forward, and trying to de-emphasize the focus on subscriber growth as it is trying to drive revenue growth, not only from adding subscribers, but also from advertising revenue and also from starting to charge for password sharing for accounts where more than one person or household is using the same account.
David, one of the knocks on Netflix has always been its inability to generate free cash flow, and they've now shown the ability to do that. And I'm just wondering, where you see that in the future as they continue to grow, as adoption grows. From what I've read, adoption of streaming service TV is say 40% North America, but only 10% in the rest of the world. And this is clearly the behemoth and the leader in this space. I'm just wondering, if you look out 5 years, where do you see the space and where do you see Netflix?
Well, certainly that historically has been a challenge for Netflix, that despite reporting positive earnings on the bottom line, the company had not been generating free cash flow. But in more recent years, the company has actually moved to positive free cash flow, reporting about $1.6 billion of free cash flow in 2022, and guiding towards about $3 billion of free cash flow in 2023. So we're certainly at the tipping point where that free cash flow is starting to come through, and we anticipate in future years that the company can further increase free cash flow. The company is trying to hold its content spending relatively steady around $17 billion a year, and if it can continue to grow revenue and earnings over time, that should enable the free cash flow to further improve as we look out into future years.
So why don't you have a buy rating?
The reason I don't have a buy rating, I have struggled with the valuation, in particular, as the shares have moved quite a bit since returning to subscriber growth in the third quarter. In a very short time period, I feel like the market has already tried to account a lot for the potential contribution from the ad-supported services, as well as revenue from password sharing. And it's not a situation that we feel negative on the outlook for the company's ability to continue growing. It's just trying to make sure that the shares are at a valuation level that we can be comfortable with.
David, what valuation parameters do you use? What comparables do you use? And just in your opinion, at what price do you think it would be a buy based on those valuation parameters?
Well, we use a number of approaches in terms of valuing Netflix shares, and that includes both making comparisons to other large tech and communication services companies who are competing directly against Netflix or competing for user eyeballs. We also look at a discounted cash flow approach as far as trying to predict over time how the business may grow and value the company on that basis. Plus, we use other valuation measures that help us triangulate into what we think is fair value. At Edward Jones, we don't publish specific price objectives. However, suffice to say, we would need to see some level of pullback in the shares based on our current outlook to be more comfortable with a buy rating on the stock.